Hi there, welcome to this hangout. And in this hangout, we are going to talk about the basic financial game plan. And what I'm going to help you to is to understand what kind of financial options that you have in terms of generating incomes. Of course, at the beginning, I have to put a disclaimer on I'm not a financial advisor again, and I'm not a CPA or attorney, and this is just really general financial education. I'm not trying to persuade or advise you to invest in particular investments or particular asset type or particular finance option or particular strategies, and it is really purely for educational purpose. And again, the purpose is to help you understand a little bit more of the options that you have. So when we talk about finance or talk about income in general, there are three types of income. So for yourself, there are three types of income. One is earned income, and another one is what we call passive income, and the third one is portfolio income. So what's the difference? So for earned income, let me change the structure a little bit. For earned income, it's pretty simple. It's your job, your work. You put in your sweat equities and put in your education, your knowledge, your time, and in returns you produce something which is valuable to someone, and in order to show their appreciation, they give you a monetary value, a monetary return. So that's earned income. Pretty simple. Everyone knows that, and everyone at some point in the time have it. And the second type is passive income. Passive income basically is saying you generate money through some external assets, and not necessarily just money. For example, you invest in stock, because that's more geared toward portfolio income, and it is more like, for example, you start a business, and as the business runs, it generates income, and that passes through to you. So in the IRS standpoint, it looks at it as passive. Or another typical example is you buy rental properties and you rent it out, and so the tenant pay their rent and you get income out of it. Of course, in reality, it is not really necessarily that passive, as you know. If you do a rental property, you have to manage or deal with the tenants. And if you do a business, of course, you need to work on the business. But on the other hand, if you run your business well, you were able to generate a lot of money, and you're able to pay yourself a salary. And on top of that, you'll pay yourself in the form of dividends or pass-through, and those are the real passive money. But at the beginning, you have to get what you pay for. Is basically it's a self-employed job. And the third type, portfolio income, a lot of people use it, get it too, and mostly they are through stock market or some form of investments. And in long run, what you want to do really is to reduce the amount of income from your earned income, or rather say the ratio. You should focus more and more on passive income and portfolio income, because time is limited and you only have 24 hours a day. Your energy is limited and you can only go so far, in a sense. in terms of earning income. And also another critical reason is because of the tax. And earned income is the highest taxed form of income, while passive and portfolio have different tax treatment. And in this hangout, what I want to focus mainly is on the portfolio income, because the passive income, you can spend days talking about it. And in this hangout, what I want to show you is what kind of options that's available to you to invest. So in portfolio income, there are three things you need to consider. One is you need to have certain asset, and we'll talk about it. And then another one is you have to have some form of finance to buy the asset. The third type, the third thing you need to have is some form of structuring. So I will briefly go over that too. So in terms of assets, what kind of asset you can invest in? There are four asset types based on what Robert Kiyosaki teach. One is business. Second one is real estate. Third one is paper. And the fourth one is commodity. And for business, obviously, you invest in a business like as a venture capital, or like you watch Shark Tank, right? They look at the entrepreneur's business and they are interested in it. They think there's a positive future, so they invest their money in it. And if the business go well, you make a good fortune. If the business flop, then you lose money. Excuse me. And the second type, or actually rather than the second type, let me talk about the paper, because that's the most familiar type of asset that you typically know. And paper, there are two forms. One is a public trading paper, and another one is private. Public trading is what you would probably already know: stock, bonds, mutual funds, forex, etc. Oh, missed the mutual fund. Right. And then another type is what we call exchange traded products, ETP. And ETP could be ETF, exchange traded funds, ETN, exchange traded notes, ETV, exchange traded vehicle, and certificates. And you all know that you can invest in any of them. They have their different characteristics, different risks, different cycles. And as for private, there are notes, meaning it's a IOU. So someone want to borrow money from you, so you write a promissory note and say that I lend you $100,000 or $10,000, and you would pay me back in 12 months, for example. And in the during the course of the note, you are going to pay me 6% interest. And another one is mortgage. It's pretty similar to note, but it is backed by securities. Typically, when we talk about mortgage, you talk about house, right? It's real estate is backed by real estate, just like your primary residence or your rental. You go to the bank and they put a mortgage, give you a mortgage, right? And then the third type is life insurance, and I'll talk a little bit about that also. And life insurance, typically they would promote saying it is not really an investment vehicle because it's just insurance. But if you understand, you have good financial education, you know you can treat life insurance as an investment vehicle. So besides that, real estate, the real estate everyone knows about since the 2007-2008 crash. Everyone knows about you can invest in real estate, or and you can lose a lot of money in real estate. And there are typically two categories, I would say, of real estate. One is residential, single family, townhouse, condos, things like that. And then another type is commercials. And in commercials, there are several different categories. And you don't need to know every one of them, by the way. And what I'm trying to do is just show you all the options again, right? So it is better for you to just understand what kind of category there are, and so you can do your own due diligence. So in commercials, what do you have? You have multifamily or multi-units, I would rather say. So duplex, triplex, fourplex, and then apartments or really multi-units. Right. And apartments, there are several types. I won't go into the detail of it. Basically, it's small, medium, large. And then office and retail. So retail is like a restaurant, or you go to a shopping mall or a strip mall. Those are retail. Office, of course, is office buildings or office space. And industrial, meaning warehouse, uh, really warehouse is what I can think of. I'm not very good at or expert in industrial commercials properties. And then there are mixed use, meaning it's a mix between either industrial and retail, or industrial and office, or retail and office, or even multi-unit and retail, or apartment and retail. Because, for example, multi-unit and retail is a very common property type in the East Coast. That you basically on the first floor is a retail space like Subway, and then you can on top of it there are multi-units or even condos that is shown as residentials, and people can live in there. And besides mixed use, and there's also land. So raw land, it doesn't generate any cash flow, but it's a very good way to grow the portfolio or park your money, because there's not much risk or not much damage you can do to land. But of course, there are several due diligence. Some due diligence need to do to land. For example, contamination, and is there any other environmental issue? Is any liens? Things like that you need to look into. And there's one more type that I will go over here is development. It could be residential development or commercial development. Basically, is building, right? Building house, a larger project. Because for a single family, you can have an investor comes in and tear down the whole house and rebuild it. That's basically we say is a construction, but it's hardly typically not qualified or not really qualified or categorized as a development project, because development project typically is much larger, like 20, 30 acres to hundreds of acres, and you build out the whole community. So you have hundreds of single family or commercials together and build, for example, retirement units, retirement communities, or nursing facilities and things like that. So that's real estate. And on the commodities, there's typically just precious metal. Oh, sorry, I can't spell. Precious metal and gold, silver. We all know that, and silver, platinum, palladium, and you can invest directly in it. You can buy gold coins, silver, what they call medallions, or you can buy ETF. Of course, those have very different characteristics, and that really gets in on the ETF, ETN on the paper asset side. And there is this subject. Of course, gold itself is subject to market fluctuation too, but on the paper side, if you buy a ETF, it's subject is even more because it's a public market and it's very easy to access. Right? You can just go to your trading account and buy and sell it instead of buy a physical gold and hold it, or a silver and hold it. Of course, there's pros and cons between the two, and we won't get too much into it. One of the main thing is about hedging against inflation for precious metals. And besides that, or you can have oil, you can have corn, food and future contracts, and I won't go into all that. And commodity related business. Last one, excuse me. So you could buy buy a stock of the oil company. Of course, that goes back into the paper asset side of the things. So you can see this is not a complete list, but it gives you a pretty good idea. There are a lot of things that you can invest in to generate the money. And again, I can't stress that enough, that you cannot, will not, and should not become an expert in every single one of it, right? Because your energy and your time is way more limited than you imagine, or I should say you already know, that it's just not possible. So for example, for myself, and for Unison Ventures, we mostly focus on note mortgage and some of the real estates. That's about it. And of course, you could trade on paper yourself, or you could do any of that. So the key is to find out what are the characteristics, what are the risks associated with each of them, and what's the return, so you can balance it out, or you can find out which one do you really like. So besides assets, the next things you need is finance, right? You cannot, well, you have, I say you have identified you want to do real estate, and you want to do residential real estate, and you learn and understand what's the risk and reward of it. But how do you get started? You need to have some money, right? And the finance, what I going to say here is about the sources, different kind of source of finance. Where can you get the money, right? One is very simple, cash. If you have work your whole life and you have make some money and you save some money, so you have some cash there. So you could use the cash to invest. And another type is a personal loan. So you can borrow money. You can borrow money from family. You can borrow money from friends, from bank. You can borrow money. You can get a personal loan from bank. Right? And then another way is through a form of line credits. So what's the difference between a loan and a line credit? Right. I assume you probably know, but just in case, line of credit is a line that you can borrow money at will. So, for example, the typical one is a HELOC, stands for home equity line of credit. So you have a primary residence, for example, it worth, when you buy it, it worth $300,000, for example, just an example. And so you put 60,000 down, so you have a loan of 240,000. And 5 years later, the price goes up, your house value goes up, it become 500,000 now. And to keep the number simple, you still have 240,000 mortgage in principle. So you could get a line of credit. And you can line of credit, depends on the bank or depends on the finance institution. You can get from 70% up to 85, even 90% of your equity and become a line of credit. And in this case, it will be 400,000 minus 240,000, which is 160. So you get a 160,000 line, and it doesn't charge you any interest at the beginning because you haven't started using it. But so it is kind of like a checking account. You could go and get money from this account, and the moment you start to get it, the clock start ticking and the interest will start to incur and you have to pay interest. So you can borrow that money for any reason and spend on anything that you like. But of course, one good way is to utilize the money to make the money for you and invest in something, get a higher return. You pay the HELOC and with a lower interest rate, and you make a spread, what we call a difference, and so you make the money that way. Of course, again, I'm not promoting any finance strategy or any asset type, and just give you one of the examples that you can do and give you an overview of what line of credit is. So besides HELOC, what kind of line of credit can you get? You can get in some bank a CD line of credit. Just like a personal loan, you can also get a personal line of credit. Or if you have a small business, you can also get a business line of credit. Of course, on the loan side, I would actually rather say personal loan before. Oh, besides that, you can also get a business loan. Simple enough. And besides those, you could credit card. You could get money from credit card. Of course, it's not necessarily a good way to do that because the credit card rate is high, and there's something called loan consonant, which I won't get into, meaning you have to pay a lot of money, or comparably, depends on the ratio, each month, and it increase your risk. The bottom line is. And besides those, you can get money from your retirement funds. And retirement funds, it could be 401k, it could be IRA, it could be something called a QRP. And you're probably very familiar with what 401k and IRA is. And so basically, is borrowing. What you do is you borrow money from the You borrow money from the 401k and IRA or QRP and use it for investment purpose. And then another way is that you can invest directly in through your retirement fund, through your 401k or through your IRA, if your 401k or IRA is self-directed. And that's one of the reasons I'm doing this video, because last Thursday we have a session talk about self-directed IRA, and because of the technical difficulties at the beginning, we lost about 15-20 minutes, and I didn't have much chance to talk about why should you care about self-directed IRA. And this is the reason that you can use it to as a finance source to invest in the asset type that you choose. So besides retirement fund, what other things? There's life insurance, and in the life insurance you can use the cash value. Of course, I'm not advised for that. And you can also borrow money from your insurance. It depends on the insurance you have. So that covers most of the options you have in finance. And of course, there could be other stuff that I miss. But if you know, feel free to let me know, comment in the session below, and I would add it in or address it in future Hangouts. So the third thing you need is structuring. So you have asset, you have identified type of asset, you have identified which finance source you're going to use. Then when the deal comes, when there's an opportunity comes, what you're going to do, right? You're going to just put the money, invest in it, or you somehow structure it in some way. And typically, I would just keep this session very simple, because as I said, I would like to keep the session within 30 minutes or even 20 minutes, and then right now it's already half an hour past. So for the structuring, there are two types. Either you can create it, structure it as debt, or structure it as equity, meaning you can create a loan for that, create a loan and lend money to someone to buy the property, to do the investment, and you hold a note, or you become the owner, so to speak, and put the money as an equity position. Again, there are pros and cons between the two, and you really need to understand what's the difference between them, so that you could do you can have educated investments. All right, so that's it for today. That's the quick overview of what you can do, what are the options that you have in terms of investing or in terms of making more money. One last thing I want to say is, why do you want to make more money, right? Although everyone should know, it's about having a better life, having a better lifestyle. And in the next session, next week, I'm going to talk about the financial game plan. And actually, I have an Excel spreadsheet that I can share with you to go over what are the goals you can set up for yourself, and how would you able to keep track and achieve them. All right, and that's it. All right, have a good day. Bye-bye.